The famous investor Paul Tudor Jones once said that the 200-day moving average is the first indicator he looks at. Why is that? In this video, we tell you why Tudor Jones looks at the 200-day moving average and why it's a useful trading indicator. We show you trend-following trading strategies as shown on the screen and how you can use the 200-day moving average as a filter for short-term mean reversion strategies. First, let's show you how the average looks on a chart. The red line is the 200-day moving average, and it moves up after the price has gone up. Thus, it's a lagging indicator. We also spot that there are many whipsaws when the price moves sideways, which is a problem for all moving averages. Now let's look at why Tudor Jones uses the 200-day moving average as a trend filter. We're only invested when S&P 500 are over its 200-day moving average, and we sell when it ends below the average. Since 1960, this simple strategy has performed well. Excluding dividends, the return is 6.75% compared to buy and hold 7%. What makes the strategy good is that you have smaller drawdowns compared to buy and hold. Max drawdown is only 28% compared to buy and hold's 56%. The reason for the reduced risk is that you avoid some of the worst bear markets. For example, the chart on the screen shows how you sold out in late 2007 and avoided the bear market of 2008 until you re-entered in 2009. You avoided a 55% loss. When the dust settles, you start compounding from a higher level. This is why Paul Tudor Jones uses the 200-day moving average. If the price is above, it's a bull market, and when the price is below, it's a bear market. It's a simple concept. But in trading and investing, simplicity helps you a long way. Let's look at how you can use the 200-day moving average to filter out when to take short-term trades. We use a standard mean reversion strategy to buy when the 5-day RSI is below 35 and sell when it rises above 50. We backtest the ETF that tracks S&P 500, SPY, since its inception until today. Albeit a rising curve, you would have experienced pretty tough setbacks. The trading metrics are not bad, but max drawdown is pretty high at 29%. We suspect most traders would have quit the strategy after such a loss. What happens if we add a 200-day moving average filter? The strategy is the same, but the close needs to be above the 200-day moving average to generate a signal. Adding the trend filter smooths the returns, the 200-day average filters out volatility, and makes it easier to follow the strategy. The number of trades go down, but the average gain per trade and win rate go up. The win rate is an important metric because of the human bias to suffer more from a loss than an equal win. If we turn the trend filter upside down and only take trades that are below the 200-day moving average, we clearly see that the performance is more erratic compared to when it's above. That makes sense because history shows that volatility is twice as high under the 200-day moving average than when it's above. Can the 200-day moving average strategy be improved or made different? Please comment if you have suggestions. Good luck trading!